Hi everyone, welcome back to Atrium Research's YouTube channel. Today I have the pleasure of interviewing Peter Gianulis, the CEO of A2 Gold Corp, formerly Allegiant Gold. A2 Gold is a company within our coverage that trades on the TSXV under the symbol AUAU, and we currently have a buy rating and $1.20 per share target price on the company. Peter, we've had you on before, but today I think we've got a bunch of updates for the viewers. So with that, great to have you here.
Thanks, Ben. I appreciate being here and looking forward to providing you with a lot of updates. Been a very busy 3 months for us.
Yeah, it has been, and I think it's going to be a busy year or next 18 months or so. So with that, I'll leave it to you to update the viewers on everything that's gone on over the last, 6 months or so, and then we can talk about the future and what's planned over the next 12 months here.
Okay, thanks, Ben. Well, I'll start with a few things. As you guys have been following us, or people that have been following us, we've been advancing our flagship project, Eastside, over the past 5 to 6 years that I've been running the company. We have drilled about 25,000 meters over that period of time. The last resource report we put out was in the middle of 2021 with about 1.4 million ounces of gold and approximately 9 million ounces of silver. Now, since then, we've drilled approximately 20,000 meters. But over the last 3 months, and I'll focus on the last 3 months because I think that's been more of the game changer over the past 5 years have occurred actually the last 3 to 4 months, where three things essentially occurred. One is that we raised a significant amount of capital. Two is we changed our name from Allegiant Gold to A2 Gold. And three, we've now undertaken and started the largest drill program we've ever done over a 12-month period of time since our inception, which also includes a property-wide geophysics program. So I'll start with the first one. Our decision to raise 14 million Canadian over in two different tranches was predicated on bringing a very strong investor group, primarily Americans, have come in into the financing. We did two financings, one at 28 cents, and the last one we just recently completed at 50 cents, which brought up $14 million into our treasury. It was a decision to raise the capital, as I thought, and I think our board also thought that the markets were turning, and henceforth it made sense to go from a conservative tilt to a relatively aggressive stance, which is what now we have shifted in from to fairly aggressive, where we'll undertake a large drill program. So a few things I want to mention about that, which I think are worth mentioning. The last financing we did at 10.5 million, we were able to get a voluntary hold of 12 months on the units and the securities. Two, Kinross led the round, so this is their second financing they've done with us over the last 3 years. And then we brought in Mr. Eric Sprott as a new investor and welcomed him as an investor. And then the other amounts were primarily taken by U.S. investors, which is, from our perspective, being a U.S. company with U.S. assets, was a very good thing for us. The second thing was the name change to A2 Gold. That was primarily predicated on our new stance of going from a conservative stance to an aggressive stance, in which our entire goal now is to drill out Eastside. Eastside's a 92 square kilometer property. Less than 20% of it has actually been drilled out and explored. There's significant upside potential. We believe that there will be multiple discoveries made within the Eastside, and so A2 Gold will reflect that. It's A2. It just essentially comes from AUAU. Our symbol remains the same. Everything else remains the same. Our management team, our board of directors, our technical team all remains the same. So nothing really changed. It's relatively consistent, but we thought that a name change and an image change would do us well. And then the third thing that has happened over the last 3 to 4 months is we initiated two things. One, for the first time ever, a property-wide geophysics program to cover essentially the entire 90 square kilometer property. This, in our belief, was something that was missing to best understand all the other exploration targets that we have on the property, and we just wrapped up the geophysics program just recently. Henceforth, we will have targeting data and leading to additional new targets, which we plan to drill with our RC program upcoming. The other aspect is we initiated a 2,000 meter three-hole program to test the higher grade zones within the Macintosh zone of Eastside. And that is something that has never been done before. The discovery we made back in 2021 was absolutely spectacular. Some of the holes were bottoming in 40 grams a ton, 30 grams a ton material over 3 meters. And those were the last few assays. And it was an RC program at that time. So we brought in a diamond core rig to test the depths of that. So we're drilling down close to 600 meters on these holes. We have finished the first hole. We're now halfway finished through the second hole, a little bit past the halfway mark. And we're looking forward to that, to getting those into the lab. The first hole's already in the lab, and getting those results over the next, we estimate 2 to 4 weeks, most likely closer to 3 to 4 weeks from the time they go into the lab. The labs are being extremely efficient. So after the diamond core program is completed, which should be completed in about a month, we would expect to initiate the 18,000 meter RC program on the back of that core program, and on the back of having all of the data compiled and the targeting data for the RC for the geophysics program that will help us select those targets. So all in all, a lot of things going on. We'll be drilling. The RC program, I anticipate, will be depending on how many rigs we can get on site, but essentially between 4 and 6 months, the program will last. And depending on the depths and the targets we choose, most likely somewhere between 60 to 80 holes is anticipated. And so there's just a lot of information. A lot of that program, depending once again on the geophysics, some of it will be expansion drilling and some will be exploration drilling. So all of that, in my opinion, gives us a strong, and then it'll ultimately culminate in an updated 43-101 resource report, something we haven't done in 4 years, and gold was $1,700 an ounce the last time we did it. So I'm actually very, very excited about some of the results we'll get, and looking forward to it, and with lots of anticipation on how large Eastside can ultimately become.
Great. No, I appreciate that update, and I think it makes a lot of sense pivoting from a conservative position, minimizing dilution when you're not getting the return on your investment by putting money into the ground over the last couple of years, and then taking advantage of the opportunity, which is gold at $3,800. The market's doing very well, and hopefully things will continue. But maybe just for the viewers quickly, you can touch on, because I think it sort of paints a picture around your responsibility as a manager of your company, around what you had done over the last few years to minimize that dilution. I think in our initiation report, we had a comparison of your dilution over a few year period compared to the peer group, which was a small fraction. And then even you did have some opportunity to generate cash through other projects that you guys had, and you were able to get creative to bring in some money. So maybe you can just touch on that. I know it's not too important going forward, but it is nice to highlight.
I mean, our disdain for dilution comes primarily as a result of us being large shareholders and having invested significant amounts of capital. When I say us, I mean myself and the board of directors and management. So over the past 5 years, we've always took a stance of shareholder protection through dilution. Now, the counter to that is, well, how fast can you advance your project? But as you correctly, at least from my perspective, correctly have outlined, is, well, even if you had some decent results, the market didn't reward you on that. I believe that has changed now. I actually believe now the market will reward exploration and project success. And so we have shifted that. But to answer your question, what we have done, when I took over, we had approximately 12 or 13 projects at Allegiant at that time, A2 Gold, and we went on we executed a strategy that was essentially monetizing our non-core projects. So we did sell Mogollon, we sold Clayton Hills, we sold other projects to Four Metals to Barksdale and Mogollon to Suma Silver at that time, and we were able to raise approximately $8 to $10 million over those 4 years, which were essentially non-dilutive financing to the shareholders. And today we are now left with our flagship project, Eastside. We have now reconsolidated Bolo, so we own 100% of Bolo, and we own 100% of Goldfield West. Now on Bolo, we recently acquired the additional 50% we didn't own from Copar, and now own 100% of Bolo. People forget that in 2017, now I wasn't the CEO at this time, but in 2017, when it was farmed out to Berrien, Bolo was one of the hottest projects in all of Nevada, and so hottest exploration project. So now under our control and management, Bolo, we will work on a few things with Bolo. We have a lot of data now with Bolo, with geophysics and drilling, and we believe that also has a potential to be an amazing tier one type of project, right? So it's in the best jurisdiction. It's very close to Round Mountain, checks a lot of the boxes, and now it's just a function of just doing a few things that I think that Bolo needs, and then ultimately either we're going to do something with it ourselves, or we'll find the right partner to be able to explore and advance that project. But it is a wonderful project.
And yeah, I was gonna ask about that. We may as well now, just on these other projects. How do they fit into the picture? I know you just touched on Bolo there, but Goldfields West, the other projects, how do they fit into the exploration plan over the next 12 months? Is there much capital that's going to be allocated to them?
No. So the answer is it fits in, is that those are the projects we've historically been reluctant to sell, waiting for a better market. And to answer your question, there is not a lot of work planned for both of those. There's going to be some small little things, potentially geophysics and some sampling and mapping programs, as well as permitting and things that we think that these projects both need to get them to the stage of either someone drilling it or us drilling it later on. Right now, we're singularly focused on Eastside.
Yeah.
We believe Eastside has the highest probability of all our projects to be a massive deposit. It's a very large deposit today. Today, with 12 million in the bank plus 10 million in the money warrants currently, we have the potential to have over 20 million in capital in our treasury over the next 6 months, essentially. And Eastside needs that, and I think that we're better suited putting that money in the ground at Eastside and trying to prove up a much larger deposit. As I said, the last 43-101 gold was at 1,700. So we all ask our question ourselves is, even if we did no more drilling, what's the size of Eastside today at 3,600 gold, right? Or 37, or 35, or 3,800 gold? And that's a question we'll answer very, very soon. But on Bolo and Goldfield West, wonderful projects. We have entertained and continue to entertain offers. We're just very, very selective on farming those out, or an outright sale for cash is just a negotiation of a price. But most of the companies that have approached us don't have the cash to buy it, so they want to do a farm out deal, and that requires us to do due diligence on them, and we just haven't been able to find a group that we believe can advance the project, and then we're going to be a shareholder in that company. So that we would like to be a shareholder. We've been very, very lucky, or good, depending on how you look at it, of selecting our partners in the past.
Yeah, no, I think that makes a lot of sense. And again, even just what you just mentioned there goes along with the conservatism, making sure each decision is made with, not rushing things, taking a lot of time, not looking at the short-term gain. You're looking at you know, essentially partnering with whoever takes over that project. You'd like to be a major shareholder for a long time, and ideally, making multiples on that project as they develop it. But so going with the Eastside, completely understand. I think it makes a lot of sense to focus on one project from a storytelling point of view, but also capital allocation. Um, you mentioned this in the intro there, 20,000 meters planned this drill program. You've got the 2,000-meter diamond drill program going on right now. Can you just touch on um, the diamond drill program? What's the importance of those three holes? What are you targeting? Why are you targeting that area? And then we'll talk about the more broad drill program after that.
Yeah. So we drilled in 2021 a series of holes that encountered very high grade gold at some level of depths between 240 to down to 390, 400 meters. And it was an RC program, and we never really followed it up to test the vertical extensions of this high grade zone, with the thinking that Eastside or Macintosh zone, more than Eastside, which is one of the two zones that are mineralized that we've discovered and have a resource on, could potentially be a starter pit high grade zone at depth, and then terminating or culminating in a lower grade open pit heap leach oxide deposit. And that it was the thinking. We never really tested significantly at depths, and so the first hole that we designed was to test the vertical extensions of that high grade zone, and it's designed or was designed to go down to about 2,000 feet. I believe we got down to about 1,850 feet, and that was where we cut the hole, and now I've moved on to the second hole. The second hole is a angled hole designed to intercept different structures and fault areas within the high grade zone. It's designed for another 2,000 feet, 600 meters essentially, and we're about a little past the halfway mark on that hole. So I think it has two primary objectives. The first is discuss the higher grade aspect, and the second is to test the contact points between many of the structures where grade has been correlated to those contact points, and we just want to prove that out, and that will help on the upcoming resource estimate. If we can get confidence around those contact points, then we believe that the resource will grow significantly more, as the consultant will have a better understanding of the structures and not only the primary but the secondary control systems and potentially the tertiary control systems. And the third hole, which will start probably, essentially could start within 2 to 4 weeks, will be designed to test another set of structures, which we initially designed it one way, but now with our team and looking at results, we may have changed the objective on that, and we haven't announced that yet. So
right. Okay, understood. And maybe just for the viewers, I'll mention a couple of those highlight intercepts that you had previously hit with those deeper holes. I think it was hole 243, 2.6 grams per ton over 148 meters, which included much higher grade in some smaller sections there, 22 grams per ton over 14 meters, which is obviously very significant, 173 grams per ton over or that was silver, and 173 grams per ton silver over 20 meters. I was like, that can't be right.
yes.
And then even hole 239, 39 grams per ton over 3 meters. So some serious grade down there. And again, you mentioned at depth, but even 3 to 600 meters is really not that deep in this day and age. But then going back to the existing resource, 1.4 million ounces inferred at what was considered relatively low grade at 0.54 grams per ton. I do like to highlight nowadays that that stigma around the less than a gram material for open pit was considered very low, even just a few years ago. But with gold at $3,800, it's effectively 1.3, 1.4 grams per ton if you were to be considering it at $1,800 gold like it was a few years ago. So, um, can you maybe just touch on the objective of getting that 1.4 up into the 2 to 3 million ounce range, the reason for that objective of an open pit oxide resource, and then having this upside at depth. And the reason I'm queuing you up here is it does point to some surrounding peers of legitimate operations that sort of started off that way.
Yeah, I mean, I think with respect to resource estimates, that there are many levers that you can play with. One is, your cutoff grade. The two is the geometry and what you're looking for. You can I mean, Eastside, we could have designed it as a 1.2 gram open pit uh, deposit with less total resources
Mm-hmm.
or ounces out there, if that's the way we wanted to design it and market it. The reality is we tried to use a cutoff grade that is economic in an open pit heap leach deposit in Nevada. And it's called that 0.15 grams as the cutoff. If we would have raised the cutoff grade to zero point 0.3 or zero point 0.4, then obviously the grade goes up. I mean, so there's a lot of levers in playing with the resource estimate. What we've always tried to do is look at what are mines that are in production using as cutoff grade. And, you look at Round Mountain, I think the cutoff grade may be actually closer to zero point 0.1 or less now.
Right.
And I think Round Mountain is producing at less than zero point 0.3 grams a ton on the open pit heap leach part, and earning significant amounts of money. You really have to look at it from how much does it cost to move the rock and process the rock in open pit heap leach. And those numbers generally now are anywhere between, including G&A and well, let's leave the financing costs aside, but G&A in a large scale open pit heap leach project, which Eastside potentially has the potential to be today, would be, at a 2 to 3 strip ratio type of number. You're looking at $12, $13 a ton of rock. And if you're mining like an Eastside, a 0.6 gram type of thing at gold at $120 a gram, well, that kind of gives you that number. Then at a 70% recovery ratio, you can kind of do the numbers. You're looking at
Mm-hmm.
$50 rock or $40 rock, and at $50 rock at $15 of whatever it's costing you, that's a lot of money you're making, right? Even if you add, the infrastructure and the fixed cost of and financing that cost, you're still making significant amounts of money. So
Yeah.
open pit heap leach has proven to be the most profitable model in
Yeah.
Nevada, and you know people are mining 0.25, zero point 0.3 grams. I believe the sweet spot for open pit heap leach is somewhere between zero point 0.6 to 1 gram a ton. That I've always considered the sweet spot. Over a gram, then maybe milling kind of takes, 1.2 grams milling may have some advantages, but zero point 0.7, zero point 0.8, zero point 0.6, 1 gram is
Mm-hmm.
just, it's a moneymaker today.
Yeah.
So that's the first aspect. There are Round Mountain, I believe, is the largest open pit heap leach project in the world. It's produced 18 million ounces of gold in an open pit heap leach. They are, I believe, Round Mountain started with a resource of, I believe, less than a million when it first was discovered. And so 1 million has turned into 18 million. And I believe that in most open pit heap leach projects, they just continue to grow.
Yeah.
I just have never been around a project in Nevada where it starts at a million and ends at a million. It's usually starts at a million and ends at five
Mm-hmm.
or 3 or 7. In terms of our potential and why, you know, 2.5 or 3 million as the number, and I'm just remind everyone we haven't done a resource update in 4 years, and by the time it'll come out, it'll be 4.5 to 5 years. And gold is more than doubled, and we've done more drilling. Um, I believe the 2.5 to 3 million ounce puts you in a rare group of companies or projects um, that puts you in a category where majors will take you out, right? Or there is a monetizing event.
Right.
And I say that because at 3 million ounces, we'll use three, it's just an easier number. Your recovery in a heap leach will be 70%. So the recovery of that gold is 2.1 million, which means that you could build conceivably a mine that will produce 200,000 ounces a year for 10 years. And I believe that is the bar that most major, whether that's Kinross, Anglo Gold, Newmont, Barrick, Agnico, that I believe that they're not looking at any deposit and that cannot produce more than 150,000 ounces a year. Now,
Right.
in the case, there's other factors and variables like, Round Mountain is there, so they have their infrastructure, they have their entire technical team and infrastructure in place. So is it 200,000, 150? Would they look at a higher grade part that can give them 80,000 and can be processed through their mill? Yeah, absolutely.
Mm-hmm.
Do I think they'll look at something smaller than that? No. I mean, they have a higher grade, meaning 1.5 gram type of thing that can give them 75,000, 80,000 ounces of gold. I think they would look at that just because they can process it in their mill within, a distance. You can kind of draw a radius around Round Mountain and say, okay, within 70 kilometers or 100 kilometers, who's around there, and that will give you, and who can produce higher grade to produce through their mill, or then you have to go to a heap leach operation that can produce 150,000 ounces.
Right.
So I think those are the real, metrics that companies look for. But if your project can't produce 150,000 ounces for 10 years, which
Mm-hmm.
puts you at a 1.8 million recoverable, which would put you at 2.5 to 2.7 in a resource or reserve. I just don't think you're going to make the cutoff.
Yeah, yeah, makes sense. And just for the viewers, proximity of Eastside to Round Mountain, maybe some other major projects. Can you just touch on that quick?
Yeah, so there's the Smoky Valley, which is where we all share that kind of valley, and within a straight line to Round Mountain, I believe it would be around 45 to 50 kilometers, maybe less, on a straight line. And then you can go down that list and you have, Manhattan, which is Scorpio, Viva Gold's Tonopah Gold
Mm-hmm.
project, you have ourselves, all within that area of projects that are known. And I think those are, there's other projects around that, but clearly there's a lot of activity going on in our basin.
Yep.
And then the next basin below that would be Goldfield, and there's a lot of activity in our Goldfield project around us. Kinross has basically staked all the land around us. Anglo Gold is very, very close to us. At Eastside, we have Kinross on one side, and on the other side, Anglo and Hecla. So,
Right.
and I mean literally bordering our properties. So,
Mm-hmm.
there is a lot of activity happening in the Walker Lane trend, and it appears to be the hottest trend or activity in, I believe, in the entire world, possibly.
Yeah, yeah, I
Yeah.
would think so. And
I mean,
and that goes with,
Golden Triangle in British Columbia has a lot of activity, but I'm talking about actual production as well as exploration.
yeah. Well, and I think we can even just very quickly touch on, um, like you said, a heap leach operation is that much quicker to get up and running. You need that much less capital to get it started. And then even with the Trump administration and all these projects starting to move forward a lot quicker,
Yeah.
definitely provide some additional support for you guys. Um, so quickly, maybe you can just touch on the ownership of A2. You mentioned Kinross participating in this most recent round. They were a shareholder prior, as well as Eric Sprott getting involved, and then even on yourself and the management team. You can just touch on sort of the ownership and cap table there.
Yeah, I mean, our ownership is in, I think, very, very strong hands. And our management previous to the financing owned, I want to say, over 20% of the stock. Most of that position was purchased in the open market. We file religiously, so you can follow our positions. I think after the recent financings, and we participated in the last one as well. Management did, and we were essentially not allowed to participate in the first one we did 3 months ago, right? Because it was taken so quickly. Um, we today own, I don't quote me on the numbers, but around 13 to 14% after all the financings. Kinross owns 10%. We have a group of institutional and American investors that own now, I believe, 30% of the outstanding structure. The recent financing that we did won't come freely trading if you want for another 11 months, but it's in very, very strong hands. And the warrants the half a warrant that we issued on both cases, one of them expires in 12 months, and that has a strike price, I want to say, of around 30 cents. And then the second one has a strike of 70 cents and is in the money as well. So, and they're really relatively short from expiry. We're not a big believer of issuing warrants, and what goes with that is issuing warrants with long dated, 2, 3, 4 year timeframes. That's something we have never done. And you never say never, but I just can never see me agreeing to that, at least as the CEO. So we have a very good share structure. We have great shareholders who have been very, very patient and have bought into the idea of prudent capital allocation, which is, I think, one of the things that characterize us.
No, it makes sense, and that leaves very little float out there, which is likely a contributor to the stock doing so well over the last 6 months. I think I looked at it before this call. It's up roughly 170% in the last 6 months. So shareholders have been rewarded, and this is just the beginning as you start to deploy this $14 million into the ground. So with that, Peter, maybe you can just close things off with a quick sort of summary of the company, where you're at, and what we can look forward to over the next 6-12 months here.
Yeah, I think today A2 is in a far different position than we've historically been. We're extremely well funded to properly drill out Eastside, which has never been the case in the 5+ years that I've been associated with the company. So for the first time ever, we can now properly drill out Eastside, come up with a proper resource estimate in terms of the dimensions of the deposit as well as newer areas, and advance the company like we would really like to advance it. So 20,000 meters, I believe, is just a start. We're well funded. We could do significantly more than that in the capital we have today. And, if warrants were exercised, we could, triple that size of that program. And what we'd like to do is, and what we're starting to do is that drilling, and that'll take us to the next stage of drilling, which we're financed for as well. And I don't think we can see, with warrants, I don't think we need to raise money for 3 years, even going extremely aggressive in doing the project. So that's what we plan on doing. There's going to be a lot of information coming out over the next, the 6 to 9 months, and it's going to be very methodical because we have a lot of drills turning, and a lot of information to come out. So I would stay tuned, and I think that we're probably going to be one of the more exciting stories out there.
Yeah, no, certainly, and that is great to hear from the financing perspective, having a long runway to take advantage of this market that we're in. So with that, Peter, thank you for the time today, walking everyone through all the updates. We're certainly looking forward to the next 6-12 months here and beyond. For our followers and viewers of this interview, if you haven't seen our research on A2 Gold, you can find it on our website at atriumresearch.ca. And again, Peter, thank you for your time today.
Thanks, Ben. Thank you for everyone for listening.